Thank you everybody for joining us. It's great to see a lot of familiar faces on the screen. I'm going to do my usual intro housekeeping stuff, and then I'm going to turn it over to our awesome guests today to discuss historic tax credits. So let me share my screen. Can you all see that? Great. Oh, this is the wrong one. Sorry, hold on. Oops. Well, shoot. Hold on a second. All right, I think I got it. Sorry about that. I hid the wrong slide. Here we go. Let's try this again. Oh, and a good reminder, if you could please mute yourselves, that would be great. That way we cut down on background noise. All right. How about that? Does that look better? All right, today we are here to discuss historic tax credits. And we have three guests joining us. Ryan Reed from the Nebraska State Historic Preservation Office. Tom McClay from Clarity Development is going to be joining us in just a moment. And then we have our dear friend Corey from the National Development Council, who's going to walk us through some case studies and show us a handy spreadsheet tool that he has modified specifically for us folks in Nebraska. I also wanted to mention that we do have deep dives that will continue on in Q2. For the time being, I think we're going to continue to do them over Zoom, as I know that that's convenient for a lot of folks. It also allows us to record the sessions in case you aren't able to attend in person, but you can catch them on the back end. These will resume after our second cohort of the Full Developer Academy starts up again in April. So in May, on the 26th, we'll have folks from both Douglas County and Pottawatomie County joining us to go over how to utilize the mapping system, the GIS system for both of those communities. There's some really great tools and tricks that they're going to be sharing with you that should help you with your projects. On June 9th, we're going to be doing a deep dive into gap financing and talking about what resources we have here in at Spark through Spark Capital that may help you fill that gap for your projects. And then on the 23rd, we're going to be doing a deep dive on business plans, what they are, why you need them, why the banks may require them, and why you might need to have them for any sort of RFP that you're responding to. So why they're a good idea and how you can get one developed. The last thing I wanted to note is that we are going to be doing another Full Developer Academy in the fall. We're not really sure what it's going to look like because we were hoping to make that one an in-person event. So if that's something that you're interested in, maybe you didn't get into this spring round, which we again had to keep very small. Please know that we do plan on doing another session in October, and we're open to feedback on what the timing of it could look like. We have done primarily work in the afternoons on a Monday through Friday basis, but we may be opening it up to an evening participation or weekend participation or some sort of hybrid, just so that we can be accommodating for folks that have full-time jobs. Let me advance to the next slide. Basic Zoom rules. Please mute your mic. If you can, type your name in so we know who's here. And then just use the chat feature if you have a question. This is a very small group, and while I'm sure our presenters wouldn't mind if you just interrupted them and asked your question, we'd like to keep it civil. So just give me a heads up that you have a question, and then I'll call on you and you can ask your question directly to our panelists. Lastly, I do want to thank our partners and sponsors for the Developer Academy. This program is highly subsidized. We're able to keep the cost affordable for everyone or free for those who need it. We have great partners at NDC and Freddie Mac who help make this possible. Our sponsors locally are Field Day Development, Olson, Baird Home, and CIT Bank. We also have sponsors in Great Western Bank, Earhart Griffin, Bluestone Development, Lamper Nearson, Dundee Bank, and Foundations Development. So I hope you'll join us in thanking them if you utilize them for any of the services you need for your projects. All right, that's my spiel. I'm going to hand it over to Ryan, and he's going to give us a brief introduction of himself and then talk a little bit about historic tax credits as they take shape here in the state of Nebraska.
Hey, thank you very much, Angela. I appreciate it. So, as Angela said, I'm Ryan Reed. I'm the Tax Incentive Coordinator with the State Historic Preservation Office. I've been in this position for the last 6 years. I'm just going to tell you about 3 different tax incentives that we have. And this is just going to be a really brief overview because they're essentially all 3 the same. They do the same thing, but when you start getting into it, you know, the details are different and there's, you know, some small changes with all 3 of them that, you know, you can kind of get lost in the weeds about. But if you have questions about it, please put your question in chat, or I'll have my information up later and you can just email me or give me a call and we can talk about any of the detailed questions that you have. Typically, I invite individual from the Nebraska Department of Revenue to come and answer any questions, tax-related questions, because these programs are all partnership programs. And the Nebraska State Historic Tax Credit, which I'm going to be speaking with, it's a partnership program between my office and the Nebraska Department of Revenue. My office basically looks at everything you're going to be doing to your building. We review the work that you're going to be doing. The Nebraska Department of Revenue, when you complete your project, they audit your costs and your expenditures, and they're the ones that issue the credit. So we kind of split up our tasks, and I answer any building questions and they answer any sort of tax related questions. So unfortunately, that individual couldn't be here today, but I will give you her information at the end of my slide as well. So let's get started. Oh, it doesn't want to advance. There we go. Let me get my notes. So there's 3 tax incentive programs that are offered through the federal government and the state government. The first one is the Federal Historic Tax Credit, and this is a credit towards your federal tax liability equal to 20% of qualified expenditures. So let's kind of unpack that sentence and what it means. So a credit towards your federal tax liability. So this isn't a grant. You don't get money up front to spend on your project. You're issued a credit that's used on your income tax liability, your federal income tax liability, once your project is complete and your expenditures are audited by the IRS. So that's how that credit works. Well, the 20% of qualified expenditures. So you have everything you're going to be throwing into this project, all your costs. So putting on a new roof, fixing your floors, you know, landscaping, furnishings, all those things. So that would be all your costs, your total project costs. Subtracted out of that are your qualified expenditures. Your qualified expenditures deal with the historic fabric of the building, such as masonry, wood floors, your roof, but it also deals with the mechanics of the building. So HVAC, plumbing fixtures, electrical, even elevators, as long as they're within the footprint of the building. And it also deals with soft costs, and soft costs such as architect fees or engineering fees, excuse me. And those can be combined into your qualified expenditures. So whatever those qualified expenditures add up to, that is what your credit is calculated from. The Federal Historic Tax Credit Program, it's a partnership program between our office, the State Historic Preservation Office, and the National Park Service in Washington, D.C. They're the ones that will actually make the final determination on the review of your project. We just make a recommendation and then we send it to them. And then the IRS, they're the ones that I said will calculate your credit and issue that credit to you. There are timelines associated with it. I have deadlines that I have to follow. I have to review your project within 30 days. And after that 30 days, it goes to the National Park Service. And they have another 30 days to review your project. I'll be completely frank with you. National Park Service has 30 days. They usually take about 45 days. Just to make you aware of that, because the person that reviews it in DC has about 12 other states that they're reviewing too. So they can get pretty bogged down with the amount of reviews that they have to do. So let's move on to the 2 state programs. The Nebraska Historic Tax Credit. This is pretty much like the federal historic tax credit, but it's towards your state tax liability. Again, it's a credit towards your state tax liability equal to 20% of qualified expenditures. So pretty much does the same thing as a federal historic tax credit, but at the state level. This is also a partnership program. It's a partnership program between my office, the State Historic Preservation Office, and the Nebraska Department of Revenue. Like I said before, with the federal historic tax credit, our office reviews the work you're going to be doing to your building. And then once you complete your project, it moves over to the Nebraska Department of Revenue, and they're the ones that audit your costs and issue a credit to you. The last one is a valuation incentive program. We call it the VIP. Basically what this is a property tax freeze for 8 years at the pre-rehab value. And then it increases incrementally for 4 years to the post-rehab value. So basically how it works, you do your project, you have to submit an application, and when you complete it, the calendar year following when you completed your project, that's when that freeze kicks in. So if you finish your project in April of 2021, the property tax freeze will go into place in January of 2022. There's deadlines with this Nebraska Historic Tax Credit and the Valuation Incentive Program as well. They're a little bit different from the Fed, but essentially there's a 30-day review of each application that we have to go through. And the Valuation Incentive Program, that's only reviewed by our office. We're in communication with the county assessor because we have to get a signature from the county assessor. We have to have them write down what the assessed value of the property is. So we're in communication with their office. And a lot of times, and this usually happens in places outside of Douglas and Lancaster County, the assessor's office aren't really aware of how the valuation incentive program works. And so a lot of times I'll get a phone call when taxes go out and people are telling me, well, my taxes increased. So I usually have to call up the county assessor and we have a discussion about the VIP program. So those are the 3 that are available through the federal and state governments. So let's talk about the application process. The application process is virtually the same with all 3 of these. Because they're essentially wanting to do the same thing. One of the differences, the federal and the VIP, those are hard copies. You have to send in paper applications, you have to send in hard copies of photographs, architectural drawings, all that stuff. With the Nebraska Historic Tax Credit, it's completely online. So you have to go to a website, create a username, password, and then you will upload all your information onto there. Since these are 3 different programs, you have to fill out 3 different applications. However, the information you put in one, you can basically copy and paste and put into the other applications. So it is, a lot of paperwork, but essentially you just have to do the work into one and you can copy and paste it into the other. So the different applications that you have to fill out. First, with all 3, there's a part 1. And this is part of the application that presents information about the significance and appearance of the building to prove that it's a certified historic structure. Well, what's a certified historic structure? Basically, if your building is listed on the National Register, either individually or it's a contributing resource to a historic district, there's a lot of those across Omaha, your building's a certified historic structure. Also, Omaha is a certified local government, meaning they have a preservation ordinance and they can local landmark properties in town. If your building is locally landmarked through a CLG like Omaha, you can apply for the Nebraska Historic Tax Credit and the Valuation Incentive Program. But unfortunately, you can't apply for the Federal Historic Tax Credit if you're only locally landmarked. So if you're listed on the National Register or you're a local landmark certified through a local government or another preservation ordinance, you're technically a certified historic structure. So with the Part 1, you need photographs of the exterior and interior of your building, especially when you're doing a federal historic tax credit, because the person that's reviewing it in DC, they're never going to come to Omaha and walk through your building and look at it. I can do that pretty easily since I live in Omaha, and I'm more than happy to come check out a building at any time. But you need pretty good documentation so the folks in DC can see your building. And there are sometimes I can't come out and see buildings, so I need that documentation as well. And the Department of Revenue needs it as well, because they're also going to be looking over the applications that I get when they audit your expenditures. So a lot of photos, and those photos need to be keyed to a photo site key. I'll be showing you an example of that later. And then a map showing the location of the building within the neighborhood or in the city of Omaha. Then the Part 2, this is the nitty gritty. This is when we get down to brass tacks, because you're going to be explaining the work you're going to be doing. It's the description of your rehabilitation. So what it does, you have to describe the current condition of the building and then the planned rehabilitation work. And with this, there's more images of the inside of and outside of your building. So if you're, wanting to redo your floors, well, we need pictures of your floors to see what kind of floors you have. So if you have wood floors, concrete floors, terrazzo floors, we need documentation that that's what actually exists. And then we also need documentation if your floors are deteriorated. So if your hardwood floors, they've gotten waterlogged and they've buckled, you could potentially replace it. You got to replace it in kind with either hardwood or engineered wood, but you have to show us like, yeah, these are bad floors and we need to replace them. That's what all those photographs are for. And then the description of work you're going to be putting in there, it's broken down by work item. So like your roof would be work item number 1. So then you're going to explain the current condition of your roof with current pictures of your roof. And so, it's like a flat roof with rolled asphalt. There's holes in the roof. It's water's getting in. That's all the things you're going to explain about the current condition of your roof. And then you're going to explain the proposed work you're going to do. You're going to rip off all that old rolled asphalt. You're going to put new asphalt on, put on flashing, all that stuff. And that's information we didn't know. Also, there's a lot of architectural drawings that we need to look at, because if you're taking down walls, moving walls, putting in new openings for windows, we need to have that documented as well, because we need to know where that's happening and where that's going to take place. So usually the drawings are of the current condition, and then demolition drawings showing, things are going to be taken out, like your HVAC ductwork or walls, bathrooms, and then proposed drawings. And that's what you're proposing to do with the place. So once we have all that information, we review it. And then once it's approved, you start work. Once you complete all of your work, you need to turn in a Part 3, and this is your certification of completed work. Basically, all this is a ton of photographs of the inside and outside of the building that basically states, everything we said we were going to do in our Part 2 application, we actually did. And here's the proof. Like I said, a lot of photographs and a photo site key where you key your photographs to basically a floor plan of your building. So that's the 3 applications that you have to fill out for each program. And like I said, it is a lot of paperwork and it's a lot of information, but that information you can copy and paste into the other applications if you're using it. So when we get a Part 2, we have to review it against certain standards. These are guidelines of how you're going to rehabilitate your building. So we have to follow them with all 3 of our programs that we have. And these requirements are called the Secretary of Interior Standards for Rehabilitation. And what they are 10 standards which are a series of guidelines about maintaining, repairing, and replacing historic materials, as well as designing new additions or making alterations to your building. The standards can be applied to historic properties of all types, materials, construction sizes, and we have to follow them on the inside and outside of your building. So I don't list the standards here, and I'm not going to go into detail about it, but the things that they cover are, adapting your building for a compatible use and for code, because you're going to have to follow, ADA, fire code, life safety code. And so we have to work with those codes and those code officials on making it a successful project. We also want to protect and maintain and repair historic features and materials. So those things that made your building interesting enough to put on the National Register or be locally landmarked, we want to retain those items. Like if you have wood floors or like an ornamental plaster ceiling or a pressed metal ceiling, we want to maintain those things. Replacing missing components in kind where design is known. So windows are a big thing. And if you have your historic windows and they're in decent shape, you likely have to retain and repair them. But if they're deteriorated beyond the point of repair, you can replace them, but you got to replace them in kind, which means they have to match the windows you're taking out in dimension and use. We have to review the interior and exterior, as I said, and we want to retain the historic character. And then we also need to review new additions and alterations. Unfortunately, new additions to your building are not eligible expenditures. You can't count that as an eligible expenditure, but we still have to review it. And another question I get a lot about federal, state, and the VIP is people will ask, can I use a tax credit on my windows, but not use a tax credit on my roof? So can I, piecemeal it out? So some things use a tax credit and other things don't. Unfortunately, you can't do that. It's all or nothing. We have to look at all the work that you're doing. Even if you're not doing any work in a certain portion of your building, we still have to see that you're not doing any work in that portion of the building. So as you can see, this takes a whole bunch of planning. If you have, your plan pretty much set in place and you're ready to start swinging hammers in a week, and then you send in an application, that's going to be tough because, like I said, we have to follow these guidelines. And if some of the work you have that you've already planned out for your rehabilitation doesn't follow the guidelines, there's changes that are going to have to be made. And also there's a lot of communication that happens between code officials, architects. If you're using other sources of funding, they have their own guidelines and requirements that they have to follow. So I always encourage people, if you're just thinking about doing a project that could use any of our tax incentives, just reach out and give me a call and we can talk about it and see if it's going to work for your particular project. I kind of wanted to show you an example of a project out in Chadron, Nebraska, and go through the part 1, 2, and 3 portions of the application. So this was a project out in Chadron, Nebraska. It's a 2-story mixed-use building in their downtown historic district. They used a federal and state historic tax credit. And here are pictures from, we have historic documentation of what it looked like historically. We had the current condition before rehab in the center, and then the post-rehab images of it. And what this building largely consisted of was a lot of exterior work. It has a sandstone veneer, which had heavily deteriorated. It had a storefront that was non-historic that was put in the 1950s. And they wanted to do repair work to their cornice at the top and the pediment at the top. There was some work on the interior, but they, not a lot, but they still had to submit photographs of the entire interior just to prove that they weren't doing any work there. So the part 1, the evaluation of significance. And what you have to put in there, as you can see here, is a description of the physical appearance. You also have to put in a statement of significance as well. But since this building's already listed, a lot of that information you can pull out of the National Register nomination or the local landmark nomination. So a lot of times this isn't anything you have to create on your own. You can just pull that information from elsewhere. And then you have to send in before photos of the interior and exterior of the building. as you can see here. And then that's keyed to a photo site key, which is on the left. It's basically a floor plan with the numbers showing which direction the photos were taken. So we can get an understanding of the interior of the building. And if you're using the federal historic tax credit, they can get a sense of what your building is like too. So we get all this information from you and then we review it. And if it's already listed one way or another, it's approved. And then we move on to the part 2, the description of rehabilitation. Like I said, you have to explain the historic and or existing conditions. And this one's talking about the largely the storefront that's on this building. They talk about, it was put in the 1950s. The door and the side lights were put on in the 70s, and it's a poor shape, and there's cracking in the storefront window glass, corrugated metal covers the transom window. And then they discuss their proposed work, what they're going to do. And so they talk about the exterior of the building and what they're going to do on the interior. And with this particular project, they weren't really sure what they were going to do on the interior because there was a drop ceiling in there that was hiding old pressed metal ceiling, but they didn't know if they wanted to go that route or not. So later on in the project, they did decide we want to expose this metal ceiling. So they had to send in an amendment explaining what they were going to do. They were going to take out the drop ceiling. They were going to remove some HVAC ductwork so you could see that ceiling. And then it's more photographs as well as what I've shown here. It's more of a detailed photograph showing the condition of the storefront. So as you can see there, some of the sandstone veneer, some of the new brick that was put in, and then the corrugated metal. Also with the part 2, we need a lot of drawings. They wanted to replace their storefront and put something back in that mimicked what was there historically. They didn't have their historic storefront anymore. That had been taken out in the 1950s, but we had a good idea from historic documentation of what their storefront looked like. The historic storefront had transom windows, large display windows, bulkheads below those windows, and it had a recessed entryway. The historic storefront originally had 2 giant sandstone pillars, but since those were gone, we weren't going to make them put them back because that would have been a large expenditure. But what they put back mimicked what was there historically for this building in Chadron. So we received elevation drawings showing it, and then we had profile cutaway drawings showing the dimensions. Because a lot of modern storefronts are very flat, and historic storefronts had a lot of dimension to them, a lot of depth. And so that's why we need these measured drawings to show that, we're putting those dimensions in there, we're putting that depth in there, we're trying to mimic what was there historically. So as I said, we go over all this information you send us, and then we make a determination if it's approved or not. Then once you complete all your work, you have 12 months to submit a part 3. If you don't submit your part 3 within 12 months, then unfortunately you don't get a credit. And what the part 3 is basically another photo site key with a large amount of photos of the interior and exterior of the building. And so here's some examples of the completed work. You can see the sandstone work that was done, a new doorway that was put in for the second story stairway, and then a detailed drawing of the horseshoe that's at the top of the building. And then we also needed interior photographs. They didn't do any work on the second story, and so they had to send in photos showing we didn't do any work at all. And then downstairs, you can see the interior of the storefront. You can see what the storefront looks like from the inside of the building, and also you can see the pressed metal ceiling that they uncovered there. So when it's approved, depending on which program that you're using, it goes to the IRS or it goes to the Nebraska Department of Revenue, and then they start the process of auditing your expenditures and submitting that credit to you. That's basically all I have to talk about today. And there's the finished product. So here's my information. There's my email, my phone number. And then unfortunately, Lee from the Department of Revenue couldn't be here to answer any sort of tax questions you might have. But here's her email and her phone number as well. So feel free to reach out to me if you're thinking about doing a project. Let me know. and I'm more than happy to talk to you about it. So that's all I got.
Thanks, Ryan. That was
Yeah.
really helpful information. I'm going to ask folks to hold tight to their questions, and we can maybe tackle those after Tom McClay joins us. Tom, are you on? Hey, oh, you're muted.
Sorry.
That's okay. I do it like every other meeting, so I'm with you. Thanks so much
By
for
now I
joining
would
us.
know better.
Yeah, well, it's just how it is. So Tom's going to talk a little bit about his experience using it, and then maybe we can pause and have some questions answered. If there are any, just let me know in the chat box, and then we'll get going with some case studies. Tom, take it away.
All right, so I am not great on Zoom, so you'll have to bear with me. So I want to, well, I'm Tom McClay. I'm a real estate developer here in town. Been doing it for, I'm a lawyer by training, and then I bled into doing real estate development about a dozen years ago or so. Did my first historic projects, a decade or more ago. Austin Apartments was kind of a little 60-unit apartment deal on 37th and Davenport, and have been willing to continue on in this world doing it since then sometimes, but it is certainly a challenge. What I was going to just try and talk to you just quickly about just maybe a little how we look at these projects from the development standpoint and whether they're worthwhile or not, and just I guess I'm not, I didn't I don't have a real kind of concise. This is somewhat stream of consciousness, and I apologize, but might be instructive. I have running through done a number of these, the biggest one being the Blackstone Hotel, now the Cottonwood Hotel. We just finished that one. In November, we opened the hotel. That certainly has been the most challenging. Anyway, I'm going to try and share my screen here and see if this can work.
Should be a green button at the bottom.
Yes, let's see. It's got a whole ton of stuff on there. Okay, let's see if, is that showing?
It's
Great.
working.
Okay, so this is, so all my speaker fees, this is what you get for artwork.
I love it.
Can you all see that? I spent a lot of time on this, as you might tell, but I do think there's something instructive here. So the problem that you have with historic tax credits is you get this really tiny little narrow window to go through. And there's even more things I could put on here that you have to navigate to actually get a project done. And I'll get into a little bit on the cost of things, but just, I mean, ignoring costs, which is a huge concern as part of this, and really, most of the reason you're doing that. These are what I see. You have a design intent and what you want to do, and then you have the historic requirements, and I would say that is a bigger circle, Ryan, than this. But you got these requirements, and then you've got the code requirements, all trying to interplay at the same time. And more often than not, your fire marshal doesn't really care about historics. Sometimes they will give you a little leeway. Your architects and even yourself and what you're trying to do, you're trying to create a product, something that can be leased, something that people want to lease, an apartment, an office, a retail space, whatever it might be. There's needs and things that you have to do there. So it becomes this game of trying to fit through this little blue area here, and it's probably even smaller, to tell you the truth. So you're kind of the three-ring circus in many ways. You've got Ryan and the historic folks with what they're concerned about. You've got the code and the city inspectors and the fire marshals, what they're concerned about. And then you have the architects and your ultimate customers and what they're concerned about. And you're the guy as a developer. For me, that's trying to navigate and keep all of those people happy. That's in me, to me, one of the biggest elements that to go down this road that you're dealing with. I just was kind of browsing around different things, and I thought I'd pull this up. Some of you might know the Red Lion bar, which is in the basement of the Colonial. The lower level of the Colonial was a hotel. We turned it into apartments. It was candidly a flop house, and was extraordinarily expensive to redo. But this is the layout, and we decided, hey, this might be a good space. It was a bar. We'll bring it back as a bar. So that was good in the sense that we got a little bit of leeway in code requirements because it was historically this commercial space. We could get some things grandfathered in, but nonetheless, we still, and we got a little bit of leeway for elevator and handicap uses because it was historic and it was previously utilized. But those are very difficult to navigate, took a lot of convincing, took a lot of time. One of the things that's not showing up for some reason on this screen, and Ryan might recall, we thought about just putting carpet. It's a lounge, it kind of might be comfortable. We just elected not to, the historic folks weren't favorable of us putting all carpet in, so we backtracked and said, let's put in rugs, and used a lot of the rug coverage throughout the entire bar area. So we, and at the same time, we wanted something that's charming, that people wanted to go to, that people were interested in having a drink, and be a commercial space. So we were trying to create an interesting aesthetic that was functional, that worked. And so this is a really tiny example of where we are navigating all three of those to kind of punch a hole through the middle there to get to something. And I'm kind of just bouncing around just a whole lot of topics to give you a flavor, because I think I've got a half an hour if I remember correctly. You're kind of doing this 3-ring circus, and the time involved to do it is immense, and to get through and to get what you want and everything is an immense process. So this is an amendment. This is just for the Blackstone Hotel. This is just the amendment that we put together for just signage. So we went in, you see this is Amendment 4. We had, I don't know, Ryan might remember, I think we're up to Amendment 9 or something. We wanted to put signage on the hotel. Once again, the design required, the design intent to have signage to make it look good, to make people be able to locate it. We also had code requirements. Signage can only be so big, it can only have certain lights, and so forth and so on. And then this is the element of the historic piece. So here we're looking at on this page, this is just the building layout. We're starting to show here, Leo Daly were the architects on this, and then DLR actually did a bunch of the interior designs. So those two interplay, particularly in a public space like in a hotel. The the floor layout here, we're starting to show in the signage plan on the exterior. The exterior, here's our site plan. This is from Oversight, where we're showing the different signage along the way. I'm sorry, these are actually different views that we're showing that the SHPO folks were interested in seeing. Jumping to, now we're getting into the details of the actual signage itself, even the color of the sign, whether that's historically accurate. The signage company, now what you'll see presently, what's out there, this is the committee signage, which is the restaurant at the hotel. This is off of Farnham Street, coming in, making our case, and this is just a part of the amendment. There's actually a narrative that followed that indicated why we believe these were historically accurate signage displays. Here you'll see the Cottonwood side now on the front of the hotel, and even there's Kimpton Hotels and Restaurants. So you'll see the little tiny sign right there, which is this here, the bigger sign. We had to get approval for that little sign for Kimpton, which is the brand of the hotel, the flag, if you will. Here's some historical pictures that we were able to locate, showing the Blackstone sign on a smaller porte-cochere. Also showing a canopy that ran along the edge there, and signage that was existing prehistorically. Here's more pictures of that signage, making our case on why we believe it was appropriate. Now we're jumping down into the side of the building. These are actually more recent pictures showing what's existing. So Ryan might have talked to the whole discussion of if something's existing, even if it's not necessarily historic, you can leave that if it's an existing or extant feature. This is the old storefront. So when it became an office building, they took out all of the historic elements. You'll see where the front of the hotel previously looked like here. In the columns and some of the terracotta that was in there and the brick. When it was turned into an office building in the 80s, they thought this was much better, and it was just this kind of very standard commercialized storefront, which we changed, we converted, we put the signage in here. These are more pictures that we're just showing what the existing circumstances are presently and how we're looking to change them. This is a porte cochere that was added, not historic, but again was there. We didn't touch it, we didn't change it. I think we painted, and because it was there and existing, we didn't make any changes to it. That was allowed under the historics. Here's just an overall picture of the hotel as it existed before, the exterior as it existed before we started working on it, which the exterior was in kind of pretty good condition, as well as historically fairly accurate, other than this porte cochere element, which was not dating back more than the 50 years. Here's side signage, and then different angles that we were taking of the hotel, as well as the existing signage that the committee sign right here. We took the Blackstone off and put the committee signage on. So this is a piece of the amendment. Then we also had a narrative that was trying to describing why we were justifying all of these. Leo Daly was great working with us on it. There's a woman, Melissa Durgangler, who we've worked with. She's a historian that helps us locate pictures, helps us locate this information. But it is a painstakingly long process for, as I said, just the signage. This is not including the lobby space, the lower level spaces, any of those which are voluminous and much, much longer. So I would say is doing historics is certainly not for the faint of heart. I would say there's a great value to it, and it's wonderful to preserve the historic buildings, but it is not an easy process. So I'm going to jump here a little bit to, is it worth doing historic tax credits? And I will say, first, without the state historic tax credit, the answer is almost always no. With the state historic tax credit, it makes it a lot more plausible. And that would probably be revealed in the number of historic tax credit deals that have been done. Then the other issue is size. The smaller the tax credit deal is, the more unlikely it is that it's worth doing. And that's because you have a lot of fixed fees, and this is a super, hypothetical kind of scenario here, that you've got a project here and spend $1 million rehabbing this building. And you then pay an architect $100,000 to do the design fees and the historic elements of all of these things that I was just mentioning. You are able to add a development fee to this, and there's some other things, but this is a real simplest example, but not far off. So in this little example, you've created $1.25 million of QREs, total qualified rehabilitation expenditures. The revenue you get from them. So when I say, I don't have, 1.25 million, I'm sorry, then you get 20% of each of those. So the state gives you 20% and the federal gives you 20%. So that's 250,000 of tax credits. I don't have $250,000 of taxes that I need on an annual basis to be utilizing. So you syndicate the credits. Most developers syndicate the credits. They don't use them themselves. But a syndicator is not going to pay you dollar for dollar for those. Probably about 75 cents. I think I missed my 75 cents down here. but really just general easy math, and it can be a little higher, it can be a little lower. And on a project this small, you likely are not going to probably get any normal tax credit investor to do it. They just probably wouldn't even look at it. Normally, they want about $1 million of tax credits before you get some of the bigger investors. US Bank invests. There's a whole plethora of tax credit investors out there. Chevron used to be a big buyer. And then there's syndicators that cobble together smaller folks. But just for sheer round number purposes, I'm saying you're going to get 75 cents from an investor. Probably not likely, but let's just kind of keep running with it. To do it, you're going to have added construction costs. 15% is probably a minimum that is going to add to your construction budget. So we said it would be $1 million that we could redo this hypothetical building. I would tag at least another 150,000 to comply with all of the historic rules. And again, you have to comply with the historic rules and then comply with the code requirements at the same time. Likely the architect is probably $30,000 extra that they would charge. Maybe it'd be 70,000. There is a large premium in there for complying with everything we just talked about, submitting everything, doing everything. You need lawyers to structure it up. You have master tenant. There's a different variety of things that you'd have to have from the lawyers and your LLCs to bring in these tax credit investors. You need accountants to do all the analysis, submit all of your part 1s and part 3s to the IRS to get your credits, to deliver it to your investors, to make sure you're compliant with the laws. The syndicators charge you a fee. They, not only in addition to only paying 75 cents, they're going to charge you a fee every year on it. Conservatively, I'm saying it's 30,000. When they come out of the investment in year 6, after you've done the 5-year hold, which I don't know if Ryan talked about, you'll take the investor out. So the investor who put $375,000 will only exit the entity for $50,000, and that might be a little low as well in terms of a fee. And then I just kind of put this risk quotient monetization. It's not easy to do these projects by any stretch. You can stub your toe rapidly on a whole host of issues where you thought you were doing it correctly. The contractor thought maybe did something that was, and now you've lost the credits. So you spent all this time and all this energy, you brought in these investors and you've lost the credits. There is a risk factor there, which I would say generously is a 10% risk factor, might even be higher than that. And so quickly in this smaller project, and not to mention just the time and your own developer's time, you're already at a kind of a wash. And I wouldn't do, if I'm only spending $1 million on rehab, I wouldn't do historic tax credits, even with the state credits. To me, it just wouldn't be worth it to do it. As an example of that, let's see. The Sternella building, which we own and purchased, I don't know how many years ago now, 5-6 years ago. Historic, a contributing member to the historic tax credit, so the National Historic District here in the Blackstone District. I actually am located in this building. It just wasn't worth it. The different things we wanted to do would have prohibited, that would have not been allowed by the historic tax credit requirements. The design intent, these are operable doors and windows that can go up. We put some windows here on the side of the building that we punched through. We just determined there was enough things we wanted to change in the building that ultimately SHPO and NPS would have just said no to it. So we went ahead and just did the building, and again, it's a smaller building. It is more than $1 million. I know we spent the rehab, but it's not the Blackstone Hotel where we were creating multiple millions of dollars of historic tax credits. It just wasn't worth it to us. So we went ahead and redid the building, and I think to still this day, I think it was the right decision for us. We didn't, obviously totally gut it. This was a Firestone tire distributorship. This is a little winged here, winged Firestone emblem that's actually cast stone in the building itself. So we didn't go way off of the historic intents, but there's just more flexibility in windows and other things that made sense for us. So that's about all I got.
Yeah, no, that's great. And I think it's good to have the perspective of here's why you should apply and here's why you maybe shouldn't. I was curious if you had, well, two things. One came in on the chat. I didn't know if you were referencing calculations or something, but all we were seeing is the hotel. Did you have, or were you
Oh,
just, was that
shoot,
just your
really?
notes? Yeah, sorry. It's okay. We're
I'm
going to be,
sorry. You should have stopped me. Can you see this? Can you see Sternella now? Nope.
no. I think you have to
Okay.
maybe
So
stop the share
let's,
and then reboot it. While you're doing that, a couple
here
of
we
questions
go.
of, there you go.
Does that work?
Yes. And
I'm
if
so
you'll,
sorry. I'm
that's
I'm
okay.
not adroit at this. This was what I was referring to. Just this really generalized kind of analysis of the fees. So that probably didn't make a lot of sense when I was just blabbering on and on.
That's
But
okay.
here's what I was
I'd love
talking
to,
about.
I'd love to send this out to folks afterwards so they can have a little bit of chance to digest it, because we're going to be going through numbers with Corey's case studies here in a minute too. So don't
I
sweat it. Don't
apologize
sweat
about that.
it. I should have stopped you. But the question I did have is $1 million doesn't seem like it pencils out for you. Do you have a threshold where you might more favorably consider applying?
I would say is generally a 5 million in rehab would be very good. That would be a really nice number to work off of. You don't bust the state limit. That's going to produce $2 million worth of historic tax credits, which you might get $1.5 million for. So it probably smooths over all of the fixed costs and the like.
Okay.
Is 4 million going to work? Maybe. It also depends on, can you find that narrow hole through the code requirements, the design intent, and everything else that's out there, and how big is that area to go through? That would be the other kind of question on it. So somewhere probably 2.5 to 5 million is kind of that line, and it becomes close. At 5 million, it's probably going to make sense, and that's also if you're willing to do it. And there's folks that I know, Urban Village is an example. Scott and Jerry, great guys, great developers. They never do historic deals, never want to. Jerry in particular runs a lot of the construction. He wants to churn and burn and get projects done and move. He would just never, it wouldn't be in his DNA to spend time.
And I guess I want to then ask Ryan, from your experience, I'm assuming that you do see projects that come in with $1 million or less in construction or rehab.
Yeah, that's why I shared the Shadron project, because that's typical of most of the projects that come into us, or small projects. That one's received a $15,000 tax credit from the state and from the feds.
And that's a level, there's, let me just interject a little bit, that
sure,
there tends to be kind of what I call a donut hole with historic tax credits, where at above $1 million of credits, so a $5 million project, you can syndicate them. There are some syndicators that I can connect people with that will do smaller credits, but you do lose a lot of control when you get below $1 million. So the National Trust Community Investment Corporation, for example, will do projects less than $1 million, but they're very specific that they use the master lease model of syndication, and basically you can't make any changes. They're not going to negotiate any of the finer points of the project or of the syndication agreement. That's how they manage to get through doing smaller projects, by basically having them be as cookie cutter as possible. But really below about 500,000 of credits, it's basically extremely difficult to find anyone to syndicate your credits to. But then you get down to a level of credits where the small investor rule kicks in. And the small investor rule is that an individual that makes 100,000 AGI or less And that's unfortunately never been indexed for inflation. So we do definitely need Congress to index that, because it was set in 1986 when, doctors and lawyers made $100,000. Now, you know, um, an experienced nurse can make $100,000. So, unfortunately, it is negatively impacting more and more people. But people who make 100,000 or less can take up to $25,000 of passive income losses against their active income. And so you can, for very small deals, so if you're looking at doing a 4-unit or an 8-unit, I've seen people successfully do that, where they don't syndicate the credits. They take the credits as a part of basically it's going to be their eventual return on investment. Now, the problem with that is that you don't get the money up front, so you have to, somehow be able to bridge it. But there is kind of this I've seen very small projects work and very large projects work, but there is kind of a missing middle here where it can be really difficult. But that's one area where having a state credit can really shrink that missing middle, because the state credits are typically transferable, and Nebraska's is at least partially transferable. And so maybe in Nebraska that's down to projects that are going to generate 200,000 400,000 are going to be very hard to do. But larger ones you'll be able to syndicate because of the state credit, and smaller ones you'll be able to take the credit yourself, that you
Are you,
you
are
have
you
enough.
suggesting that, so you're saying that folks are using the credit themselves, or are
Yes.
they bringing in other people into the entity to use those credits as well?
Well, I've seen both models. Macon, Georgia has a great program. Historic Macon, the nonprofit, actually has a matching program. Well, they will help match real estate professionals with developers. So real estate professionals can actually use an unlimited number of passive credits. And so so there are more and more nonprofits that are getting into the matchmaking game. I don't know of any in Nebraska that are doing this right now, but
So Corey, how do they get around security regulations then?
you must, so it must be um, an investor that lives in Nebraska. So
So
then
they're,
it's not interstate commerce, and so it's under state
but
blue
you
sky
still,
laws rather
yeah,
than
but you
SEC
still
laws.
have, but the blue sky laws are still going to apply to you. I would say is I'd be very reluctant. I know people do it where they bring in very small investors on those deals. I would caution to talk with a securities attorney before you do that, because that is a risky possibility. If those investors come in, they can eventually look backwards and say, I am not an accredited investor, for one. And two, I gave you my money and you didn't comply with either federal laws or even state laws. And that's a dangerous, I would encourage anyone if they're
I
thinking
wouldn't do it
about
on
it.
an individual basis. I think what has made it work in Georgia is that Historic Macon has done that work. And
Yeah,
again, similar to NTCIC, there's no negotiating with it. They've got set documents that they use that they know comply with Georgia's blue sky laws. The nice thing is that, with a lot, especially with crowdfunding, a lot of states have modified their blue sky laws to make them um, with much lower thresholds in terms of being an accredited investor and so forth. So So again, I'm not sure if there's a nonprofit in Nebraska that is doing it, but you know, I can certainly put anyone in touch with some of the models that are out there of groups that are doing it. And so it has made Historic Macon is making this work with, you know, fairly small buildings. And I also think that, you know, the fact that individuals can often use these credits themselves, especially for very small projects. A lot of us that are more in the industry and used to large projects forget the fact that, you know, individuals can theoretically take these credits too. It's whether they can use it, you know, and so you have to be careful not to generate too much. You know, if you're doing a 16 unit building, you're probably gonna exceed your ability to take the credits yourself. But if you're doing you know, a 4 unit, a 6 unit, you may be generating, you know, the amount of credits that that you can actually use. So it's definitely something to, you know, one, you know, talk with your tax accountant, you know, talk with someone about it. And then also, you know, if there are a lot of small opportunities in Nebraska that are not being taken advantage of, I know that the Cleveland Restoration Society, for example, is working on setting up their own small investor matchmaking fund. You know, so this is something that more and more historic societies are finding as a great way of preserving buildings, which is their, you know, their nonprofit mission. So there's some definite, you know, I think at least for the Equitable Development Academy, I just don't know how many of them are going to be jumping into $5 million projects right away.
Yeah.
But you know,
Yep.
an 8 unit may be possible. You know.
Yeah, these are good perspectives to have for everyone on the call here. And like Corey said, it's a lot to chew on, and
Yeah.
we got some good folks who can help you make the right decision for your project.
And probably Ryan, you know, will squirm a little bit, but I actually prefer when I'm dealing with a building that is just basically in really, really bad shape, because frankly, when there's very little to save, it gives me a lot more freedom, because there's just not, you know, there's just not that much, you know,
There's
that
not
they
that
can
much to
say
keep.
about. What's that?
There's not that much to keep. There's nothing there.
Exactly.
So there's nothing to
Exactly.
retain.
Yeah. And so, you know,
Awesome.
that can be, you know, I actually, you know, prefer buildings that are, for historic tax credit purposes, that are in really, really bad shape than buildings that are even sometimes still functional. I find that sometimes those can be the really hardest to deal with, because you're going to be more restricted. You know, the Secretary of Interior standards say, you know, repair rather than replace. And so if you're repairing, you know, if you're repairing 100 wood double hung windows, you know, rather than replacing 100 double hung windows, there's there can be a cost and an ease difference there. So
Awesome. I think we're going to shift now into doing case studies. There was one question, I think it was yours, Corey, just to clarify from Ryan, if it's possible to seek out just the Nebraska tax credits without going for the federal historic tax credits.
Yeah, I mean, you can totally do that. I mean, just because it's listed on the National Register, it doesn't mean you have to go after both. You can just go after the Nebraska historic tax credit as well. I mean, we have to follow the same guidelines that the feds do, but yeah, I mean, you can do them both, or you can just do one, or you can do all three. It's whatever works best for you and your project.
Great.
yeah, so for any nonprofits, that's super important to know, because of the way that tax credits flow, federal tax credits flow, nonprofits have to end up syndicating them. They have to bring in an investor, a for-profit that can use the credits. And so, you know, so some states tie bar them, which is really unfortunate because it restricts nonprofits' ability to take advantage of the credits.
Mhm.
Great. Are there any other questions for Ryan before we jump into these case studies?
I just want to pop in real quick because Tom was giving the example of the Blackstone. That's not a typical project that we get. That was a huge.
You're kidding.
That was a massive project, and it had a ton of change orders in it. And if there's substantial changes that deviate from your approved work, you have to send in an amendment. And that one had like 9, and that's like a ton that we typically don't see. Like the project I was showing you in Chadron, it had 1 amendment, you know, that because they had to change, they were changing what they were doing in the interior because originally they weren't going to do anything, which was fine. But then they decided, hey, we got this cool ceiling up here. Let's take all this stuff down and repair it. So they had to send in an amendment for that. And it was really straightforward. So a lot of the projects I typically see, you know, especially from outside of Omaha, are smaller projects like, you know, mixed use 2-story buildings. We, you know, we have those here in Omaha and Lincoln too, but yeah, Blackstone was massive.
Not the typical case. I think he was just excited to share with everybody.
Oh yeah, no, it's a great project.
And to survive that process, I think is quite an accomplishment. But all great perspectives. And thanks so much for joining us, Ryan. You're welcome to stay on if you want to watch Corey work his magic with these case studies. But
Sure,
it's great. All right, well, I'm going to turn it over to Corey. I have dropped in the chat box 2 documents. One is a PDF with the case studies, kind of the core language around them. And then the other is a spreadsheet that Corey's going to be using. So if you just want to watch Corey do it, great. If you want to play along at home and you have multiple screens to do that, that's where they are. I will send these documents out after the video today finishes rendering so that you can have them via email too.
Yep.
It's all yours, Corey.
Okay, well, great. So we're going to go over 3 kind of quick cases utilizing a version of NDC's pro forma for which I've added some of the Nebraska programs. I've not added the tax abatement program, the IPV program, VIP program. But I did add the tax credit, and those show up on the tax and appreciation benefits tab. So I've added the Nebraska Affordable Housing Tax Credit along with a link to their website. I've added the Nebraska Historic Tax Credit along with the link to their website, and just, you know, where there was some eligibility information or other information, I've tried to add that in as well, so that you don't necessarily have to look it up. First of all, I'm just gonna try to get you oriented a little bit on the tool has 4 main tasks, 4 main tabs that you're going to be working with. The first is the development budget. And the development budget is set up so that you can put in all your costs. And these are the costs from when you start to first spend money on the project till you've placed the building into service. So placing a building into service is a really big deal for most tax credit projects. So that is basically your certificate of occupancy, Now, if the building's never taken out of service, then it's basically when you deem the project to have been completed, and you have a little bit more flexibility, but it's really hard to do a project with occupants, in it. So most projects, the building is a vacant building, and so it's been taken out of service. You're going to do a certain amount of qualified rehabilitation expenses, and then you're going to place the building back into service. So that back into service point is an important one. So this is everything from acquiring the building to any site improvements, items related to construction, items related to professional fees. You may have some costs related to the construction finance. You may have some costs related to your permanent finance. So such as points on a mortgage would go here under permanent loan fees. You may have a lot of soft costs. You can actually, for example, get the tax credit on the property taxes that you pay on the property during construction. Your construction insurance, if there's a tax application fee, all of those costs that you are spending prior to place in service. So one here that creates some confusion is marketing expense. Let me make sure that this is big enough that it's actually readable. Marketing expense here. So this is everything until you've placed the building in service. So your coming soon sign, ads in the paper, where you're asking people to pre-apply for, say, residential units and so forth. So everything up until you place the building in service. Once you open the building, then marketing expenses would go as an operating expense for the building. And then some reserves. So down here at the bottom are some things that will help you judge whether you're accounting for everything that you need to. So the first thing that I always look at is my percentage of soft cost to hard costs. A lot of people, especially small developers, tend to forget soft costs, and so we need to keep in mind that at a minimum for most projects, your soft costs are going to be about 15%. And especially if you're dealing with tax credits, those soft costs may range as far as 35%. I've even seen some cases where it has gone above 35%. There are some tax credit programs that just require a lot of attorneys and bond counsel and so forth that boost those soft costs up. But if you're coming in, if you've done a project and you're coming in at 5% soft costs compared to hard costs, you're probably missing something. And then the same with soft cost to total project cost. This is going to be slightly lower because total project costs includes things like acquisition, so and reserves. But again, there's a range here just to help guide you a little bit. It's not an absolute, but it'll help you stay organized. You put in your numbers here, and then the spreadsheet will give you an estimate of your historic, your QREs, your qualified rehabilitation expenses. And so you put in the numbers in the unshaded boxes, and they will automatically transfer over to the shaded boxes. Okay. And then it'll give you an estimate of your qualified rehabilitation expenses down here in row 67. So it's a handy guide to help keep you organized. If you don't know all of these items so let me go back to the list. You know, you may be so early on in your project that you don't have individual numbers for a lot of these items. What I'll do is often here in just my other row, the number that you're probably going to be able to get a good estimate on first is your hard construction cost numbers. And so then I'll just take, say, 20 to 25% of that number and put it in, you know, as a catch-all for my soft costs, just so that I know early on that I'm not forgetting my soft costs. That's the main part, right? Don't forget those soft costs. So it's again, mainly meant to keep you organized. The next tab is the Pro Forma tab. And the Pro Forma tab, again, helps keep you organized when it comes to your revenue and your expenses. So if the development budget is through placed in service, the Pro Forma is after placed in service. So this accounts for the revenue I'm going to start getting after I've placed the building in service, but also my operating expenses once I get placed in service. So I can have, it's 8 different types of residential units, and it's pretty easy to add to this list if you have more than 8 unit types. And 3 different types of commercial rents. There's an area here for you to put in residential assumptions. How much your rent is going to increase per year? How much is your operating expense going to increase per year? What are your vacancy rates going to be? Typically, vacancy should stabilize in either year 2 or year 3. If your project is not going to stabilize by year 3, you may want to take a look again at your project. It may be too large. And so most projects should be kind of at the even keel starting in year 3. Same thing on the commercial. How much is my rent going to go up, my operating costs, and my vacancy? I can also, if I have other income, I can have that increase at a different percentage than my rent. And the other income comes here. So as you'll notice, anything that's an unshaded box is where I can put in a number. And if it's a shaded box and I try to change it, I'm going to get this warning sign that says that I can't change it. This is mainly so that you don't break the model. If you need to make a change, the super secret password is NDC, all in caps. But just be careful in changing the model. Always be sure to save your template before you make changes. And if you ever do break your template and need a new one, just email me. There's a space here for all of my operating expenses. So this is everything to keep the building going. This is going to take this information and it's going to populate a pro forma. So a pro forma basically is an operating statement for your building. It's the business plan for your building. So how much am I going to make in terms of rent, residential rent, commercial rent? How much is it going to cost me to operate the building? How much debt service do I have to pay? And that's going to lead me to line 93, which is cash flow, which is basically what comes to the owner. Now, sometimes, especially with syndicated projects with, say a historic tax credit project, you may have some fees that your partners charge. So there is this place here for you to put those, and these are unlocked. So, whereas I can't change this cell here in these outlined cells, I can put in a number, okay? And then that gets us to the cash flow for distribution. So this is actually, what's left over to be divided among the partners. Everything kind of, below this yellow portion is all kind of the background. This is all the sausage making, that is happening here. So this will go over, this will go over determining your taxes. This will go over your bank amortization periods, lots of good information here, but you may or may not need it for your purposes. The main part is what's captured here in the yellow area. The next tab is the source of funds tab, and this is how you're going to pay for what you put on your development budget. So this is meant to help you capture the information that you need if this is a historic tax credit. So this is the federal historic tax credit program. Here's the Nebraska historic tax credit program. This is regarding the federal low-income housing tax credit, and this is the Nebraska affordable housing tax credit. There's a whole section here on calculating the debt on a project. How much can you attract from a lender? And then there's how are you going to actually finance the project in terms of debt, if you're getting any grants, and then equity. So this will look then at your total development cost minus the sources, detailed here to give you a gap number. So one of the powerful things about electronic spreadsheets is that it's very easy to make changes. But one of the dangers of electronic spreadsheets is that it's very easy to make changes. So one of the things that I definitely encourage you is to not make changes just to solve your gap. Too often what I see is people will come up with a gap and they'll start messing around with rents, for example. Well, maybe I can up my rents by $25 a month and, let's see what that does to my gap. Oh, it lowers my gap. Well, maybe I could actually increase my rents by $50 a month. Well, if you did a lot of research and, you were pretty sure that what you could charge in rent was $700 a month, you really have to think about, whether $725 is feasible or even worse, $750. And so don't just try to solve a gap with this tool. If you have a gap and you're not sure how you're going to fix it, well, that's where you start to look at things like historic tax credits. That's where you start looking at affordable housing credits. That's where you start to look at programs like maybe a longer amortization period on a loan so you can borrow more money. Those types of things in order to solve your gap. And then finally, the tax and appreciation benefits. There's actually not a lot for you to change on the tax and appreciation benefits, but one of the key ones is here with the non-RTC basis items. So not everything is going to be eligible for the historic tax credit, and otherwise known as the rehab tax credit. And so sometimes you have to manually just exclude items from your RTC basis. And in fact, the South Street Apartments is such a case where we're going to have some new construction involved in that project, and we have to remove some of the soft costs related to the new construction. So I've also included the Nebraska historic tax credit, and again, here there may be some items that you have to exclude. There's some items that you can add, which is kind of a unique feature of the Nebraska program. So I've put a little note in here for you. And the Nebraska credit's a 20% credit with $1 million maximum at this point. These I've left changeable because sometimes states do change their programs, and so that way you can update it if necessary. A lot of this other stuff, is here to help you, for example, with your federal depreciation or your taxes when you go to sell the property. All these calculations are here for you, but they don't require you to manipulate anything. There is also a construction budget tab that you can use to help determine whether you're going to have a gap in terms of construction sources. Particularly if you're planning on taking historic tax credits yourself, you have to keep in mind that those historic tax credits come in after you've completed the project. So you have to fund those up front. And so oftentimes your construction sources, you're going to have a bigger gap than your permanent sources. And then there's a way for you to very accurately estimate construction interest. For the most part, I usually use a formula, a more simplified formula to calculate my construction interest. But once I get to the point of kind of having a construction draw schedule for my construction manager, then I'll go through and I'll actually, put that information into this tab in order to get a very accurate estimate of my construction interest. Construction interest is often your third largest soft cost. So developer fees typically the largest if you're taking one. Architecture and engineering fee is typically your second largest, and then construction interest is typically your third largest. So spending some time estimating it is worthwhile. So that's a brief rundown of the of our pro forma tool. If there are any questions, I'll pause briefly if anyone wants to ask a question.
I think they're all mesmerized, Corey.
Yeah, with
it's a great tool.
Yeah, it's not perfect, and I've certainly seen more complicated tools that look at things on a monthly basis, which really really digs down deep into into the weeds. But for most projects, I find that this is a good enough format that you can explain what your development is trying to do to bankers, to investors, and to governments, and so it's I think a pretty good tool. All right.
Ready to roll.
All right, well then let's do our first case. This is a really simple case. This case is just looking at how to use the tool in terms of estimating a loan, a really important function that the pro forma will do. So take a couple minutes to read Bone, Buildings Old and New.
And again, check your chat box if you're looking for the documents and can't read it off of the screen. They
Yeah, and
are
here.
in the chat box.
I can make it a little bit larger as well. Let me see if I can get it. Yeah, here we go. Okay, so with this case, we actually don't have to fill out. We're actually not given a development budget here. We're just trying to figure out about how much we could borrow if we had a project that generated $100,000 of net operating income. So we don't have to fill out the development budget. The pro forma, we basically, there's a little tip here. In residential rent, put 1 unit at a monthly rent of $8,333, and as many threes as you want to put in there, so that we get total annual rent at $100,000. We're also not going to put in any operating expenses, and that's going to get us an NOI up. And we're also going to put vacancy at 0%. So basically what we want the spreadsheet to do, we're kind of fooling the spreadsheet that net operating income, line 85, we want that net operating income to be $100,000. And this net operating income over here on the pro forma tab is going to be picked up on the sources of funds tab. And it's picked up here in E29, stabilized NOI. Stabilized NOI is a banks will give you, much better than the toaster or the popcorn maker or whatever they're giving out these days. The stabilized NOI is basically a formula that doesn't penalize you if you're being more conservative with your vacancy in early years. So, this, and we'll see that in later cases, how that operates. But we basically need our stabilized NOI to be $100,000 in this case. So we have 2 different banks. Each bank has different lending criteria. So this area here is where we're going to put that information in.
Can you zoom in a little bit, Corey?
Sure. How's that?
Perfect, thanks.
Okay. So with Money Laundry is willing to provide a loan with a 30-year term. And when a bank only gives you the word term, that means that the amortization and the term are the same. Otherwise, what they'll tell you is, like Deep Pockets tells us, they want a 15-year term and a 25-year amortization schedule. So in this case, Money Laundry says a 30-year term, so we can assume that these two are the same. They want a 9% interest rate, and they want a loan-to-value ratio of 75% and a debt coverage ratio of 1.25. So what you'll see here is that the spreadsheet has automatically calculated for you what the loan amount would be based on debt coverage ratio, what the loan amount would be for loan to value ratio, and then most importantly, we want to put, a 3 here in E31. This is telling the spreadsheet, base the loan amount either on an amount. Let's say that the bank just told us that they're going to lend us $700,000. Well, then I'd put $700,000 here, and I change this to be a 1. And that's going to force here in C39, by putting a 1 here, I told the spreadsheet, use this amount here, okay? A 2 means use this amount, the loan based on the debt coverage ratio. But in this case, Money Laundry wants us to comply with both an LTV and a DCR. So I'm going to change this to the 3, and it's going to pick up this number from E34. So that's the answer to how much could Bone borrow from Money Laundry. Bone could borrow $828,546. Now, Deep Pockets has a slightly different set of terms. So with let's see, hold on one second. I'm just going to put a little note that says Money Laundry. Okay, so now let's take a look at Deep Pockets. Deep Pockets is only going to charge 8.5% interest, so a little bit better, but a shorter amortization period. And a shorter amortization period means that I have to pay more principal with each payment. And so shorter amortization periods typically mean I'm going to be able to borrow less. So even though the interest rate's lower, the amortization period's also lower, and I may not be able to borrow as much. And they want a 15, oops, right. So the spreadsheet will not allow you to have a maturity that is longer than the amortization period. So I actually have to change the term first. So 15-year on the maturity, now I can change amortization to be 25 years. They want a debt coverage ratio of 1.2 and a loan to value ratio of 80%. The cap rate was 9% that was given to us in the case. So now I can take a look at for Deep Pockets. So Deep Pockets, I can borrow $862,421. So both lenders are approximately the same amount in terms of our borrowing capability. Deep Pockets gives us a little bit more. My only concern with Deep Pockets is that it does have a 15-year term rather than Money Laundry, which had a 30-year term. So this 15-year term means that at the end of 15 years, I'm going to have to either pay off the loan or refinance the loan. And and who knows what's going to happen 15 years from now. So if you can get a fully amortizing loan with a term that's equal to the amortization period, that's the gold standard. It's just very rare with commercial property nowadays. It's still common with residential mortgages, but not with income property. So hopefully you've picked up how to manipulate, this section of the pro forma in order to calculate how much a bank will lend you. So are there any questions regarding this?
I don't see any in the chat box.
Okay, well, great. All right, so we can say goodbye to the big bank, and we'll go with deep pockets. All right, so let's take a look at South Street Apartments. So I'm going to open up a fresh sheet. And oops, let me put this split screen. All right, so now we have a project here that actually, is more of a complete case. We do have a development budget. So in this case, Southern CDC wants to renovate an existing walk-up building built in 1939. And it's they want to turn it into 30 units of housing for the elderly using rehab tax credits. The other name, the official name for federal historic tax credits is actually rehab tax credits. Section 47 of the IRS code is the rehab tax credit program. So you'll hear people oftentimes say historic tax credits, which is fine. It's just another way of saying RTCs. An elevator will be added to the rear of the building to increase accessibility, right? This is being aimed at housing for the elderly. So, in order to actually speed up time, because I'm running a little bit slow, I'm going to pull up the answer key version. So I don't have to key in everything. So I've entered in all of my costs here. And so the biggest thing that we have to be careful of is to properly characterize our renovation costs versus our new construction costs. New construction, including building additions outside of the building's floor plate, would be considered new construction. And new construction is not eligible for the historic tax credit. So you'll notice here in G15 that it's blocked off. It's not eligible. So so we have a $4.2 million project. this is really right on the edge of whether you could do a federal historic tax credit project or not. This is where having a state credit would really come in, really comes in handy. So the first question is, how much additional money must the CDC raise to complete the project? So not only are we given a development budget, we're also given that the bank has committed to a certain amount of money. So if you remember from the last case, if we're given a certain amount of money that the bank's going to give us, we're going to put that in E32, and then we're going to make E31 a 1 to tell the pro forma that we have $2.55 million of loan. So how much additional money must the CDC raise for the project? Well, right now, let me take out the equity. Hold on one second. We have, we only have a loan identified right now. So we need to raise $1,660,000 in order to complete the project. Is the project likely to be eligible for rehabilitation tax credits? Well, we're not given a lot of information about the project, but it was built in 1939, so it's more than 50 years old. Not that that's an absolute, but it's typically a better indicator of whether a project would be considered possibly historic. And with famous blues bassoonist Busta Rhymes Grimes lived in for 35 years. So oftentimes when a building is associated with a historic person, we can get it historically designated. So, this may be enough in order to get the building historically designated. A building, well, this was already covered by Ryan, but there are a lot of ways of getting a building historically designated. It could be the style of the building, it could be the architect, it could be an important person or event that happened at the building. What challenges may they face in terms of compliance with the Secretary of Interior standards? My typical answer to this is Windows, Windows, Windows. I swear Windows is typically, the number one challenge that I see, particularly if a building has any sort of curved windows, curved doorways, if there are any existing moldings that are still there but maybe need repair, those can be challenging. There's nothing in here though that lets us know that. The other thing is, in terms of the new construction, we don't want this elevator shaft to look like it was an original part of the building. We actually want it to look so that a normal passerby could easily tell that it was an addition. So we don't want to create what's called a false sense of history. And so, so that's sometimes a challenge. I've seen lots of cases where, architects, match the brick, they match all this stuff, and then they're disappointed because it gets rejected by the State Historic Preservation Office because it's literally too close to the original building. In fact, it's easier if you literally go with something that's distinctly modern in terms of the building addition.
Hey, Corey, there's a
Yes.
question here from Jewel that I think you could answer pretty quickly.
Okay.
Is Jewel, do you want to ask it or do you want me to read it?
I just wanted to ask, is when you're talking about what's allowable for you to be able to use historic tax credits, is adding more living units than was originally there, but within that same building envelope, considered new construction?
No, that's not considered new construction. As long as you're within the 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 original framework of the building, that's not considered new construction.
Okay. I also have one more question since I'm on.
Go ahead.
It was about your Windows comment. And I was just wondering if you were trying to reach some sort of sustainability metric and you wanted more energy efficient windows, like how would you usually handle that?
Well, so actually, from a there's been a lot of studies that have shown that the difference between a well-sealed old window and a double pane window is really not that much. So number one, that's kind of something that is not well understood. Number two is that when you look at the imbued energy in that existing window, that has to be taken into account as well. But that said, sometimes I've just seen buildings where it's been exposed to the elements for a long time. They were wood windows and they've simply rotted out. Typically, if it's just one or two windows that have to be replaced, the SHPO will ask that you try to find a replacement that very much matches the existing windows. In the case where if like more than half of the windows are extremely damaged, and it is simply makes more sense to replace the windows, they will allow you to replace all of the windows so that they match.
If I can just chime in here,
Ryan,
because
yeah.
windows always are a big deal. And what Corey is talking about, a lot of times, I don't think there's this realization that your historic windows are usually made out of much better material than, modern wood windows or even vinyl windows. And, they may be in bad shape, but they've lasted, maybe 80 to 100 years. So there's something that always has to be maintained. Houses and buildings aren't static. And so, you'd have to maintain your windows, but yeah, basically, if you have a well-sealed window with like a storm window on the interior or exterior, I mean, you're going to get pretty much the same value that you would get from putting in a new window. And yeah, that's true. I mean, that's one of the things we have to look at when we're looking at replacement of windows. You have to prove that they're deteriorated beyond a point of repair. And, that's more than just like cracked glass or failing paint. You have to show that, pieces of your windows are missing. And if that's the case, and you show that it can be replaced, then you can replace your windows. We just have to look at that they match the dimensions and the sizes of the window that you're going to be replacing.
Yeah, I would say that one of the hardest ones that the hardest decisions that I've seen has been on the middle multiple divided lights that were often used in industrial facilities. Those, and typically since they weren't double hung, they were swing out windows. They typically don't have an easy way of doing a storm, and so those can be problematic. And replacing them, can be really hard to find a good replacement window that matches the style. So that's where you really want to work with your state historic preservation office to see what other products and projects that they've seen. So for example, I worked on a project in Detroit where the SHPO helped us identify 3 different window manufacturers that produced a replacement window that was a double pane with the I'm not an architect, so I can never remember the interior divides, for the
The bullions
lights.
and muttons.
The bullions and muttons were
Mhm.
similar enough to the original that they would approve them. But it's definitely something to start with an early conversation with preservation office, and the one thing that I think is just critical here is to work with an architect that not only has worked with historic buildings, but has specifically worked on historic tax credit projects before. So of all the architects in Michigan, and I've done a lot of projects here in the state, there's maybe 4 or 5 architects in the entire state that I would really trust, that I know understand the program well, and so hiring someone with that expertise is well worth the cost.
Hey, Corey,
Yeah,
it's
agree.
just about noon. I think that's a great
Yeah.
advice to end on. What I'm thinking we should do is maybe
Well,
you and I can work up do
Yeah.
you want to finish this
There's
one?
just
And then
one. There's just I want to address question number 3.
Okay, and then we'll send out a PDF answer key
Yes.
for the other ones.
That's right.
Okay, if you
And
have to
so-
log off, no worries.
Yep. And so, and it's here in the non-basis items. This project includes some new construction and some renovation. And so one of the things that you have to do is the construction itself is automatically excluded from the basis from your QREs. What's not excluded, actually we updated this. So this is even simpler. You'll notice that from the architecture and engineering side of things, the what's being included in the QRE is less than your total cost, because only the architecture and engineering fee that's related to the rehab is eligible for the credit. So you want to keep that in mind as well, that when you are mixing some new construction and some rehab, that it's going to reduce your QREs. So that was the only thing I wanted to point out. We will get a set of answer keys, and I encourage everyone to try to do South Street and the Bach on your own, and feel free to contact me if you have any trouble.
It's a great exercise. I did it and he ended right where I got stuck. So I'm glad I'm glad I understand how to get there now. Thank you everyone for joining us. Thank you, Corey, for these great tools. Thank you, Ryan, for the great information. And thank you all for participating today. Please stay tuned to our website for details and registration links for future deep dive sessions. I'll be sending out an email today with all of these materials, the answer keys, and a brief satisfaction survey. Please take it so that we can share with our partners and sponsors how important this information is to get out to folks like you. Thanks, everybody. Have a great day.